Hey everyone, welcome back to the channel. So today we're delving into some important economic data that could shake up the stock market, the crypto market, and other risk assets as well. We just had the latest producer price index, PPI numbers, roll in, and tomorrow we'll be getting the consumer price index, the CPI data. So if you're an investor or just someone who's essentially trying to track where the economy is headed, this is a set of reports that you don't want to ignore. So let's go ahead and break it all down. Before we jump into details, a quick refresher. Producer Price Index measures the average change over time, the prices domestic producers receive for their goods and services. Essentially, it's a look at wholesale inflation, the cost that businesses pay before goods reach us, the consumers. So you should care about this because when businesses pay more for their products, they often pass those costs on to the consumers. That can become a leading indicator as for what you might see as a consumer with essentially inflation levels, which is measured by CPI, and that data comes out tomorrow. In other words, if PPI is rising sharply, CPI might follow suit in a few months. If PPI is cooling off, that's a signal that consumer inflation might also start to ease. According to the Bureau of Labor Statistics, BLS, the December PPI data, it showed a mixed bag. Some categories were rising more than expected, others showing signs of moderation. It's still fresh off the presses, so markets they're still kind of absorbing the information, but headlines suggest that producer prices came in hotter than forecast in some subcategories, while energy and certain good categories, they cooled. The bond market wasted no time in reacting. Treasury yields climbed almost immediately, reflecting concerns that inflation might be stickier than we had hoped, or at least that the Federal Reserve could keep interest rates higher for longer if inflation doesn't start to come down fast enough. We've seen a rally in yields over the past week, and it continued with this PPI release. So why do higher yields matter? Well, they often mean investors are anticipating either higher interest rates from the Fed or simply a persistent level of inflation that forces yields to stay elevated. And that could put a lot of pressure on equities, especially like growth stocks, essentially, or risk assets like crypto, because money becomes more expensive to borrow and future cash flows get discounted at a higher rate. So heading into the PPI release, we saw some choppiness in the major indices. The S&P 500 and NASDAQ had been somewhat shaky ground. They essentially, they chop around these uncertain press releases. That's why I always say never trade around these types of press releases. It's just too much volatility. It's not worth trading. But the market was essentially, they were unsure whether to build on previous rallies or pull back in anticipation of higher rates. Once the PPI numbers hit, though, markets got a jolt of volatility. It wasn't necessarily a meltdown, but you could see that traders and algorithms, this is why I say don't trade them, they start processing that data in real time, and everything just gets extremely choppy, and you see that classic zigzag price action. The stock market has been trying to hold on to its gains from the last few weeks, largely built on hope that the Fed might start to loosen their stance this year if inflation data starts to show more improvement. However, the PPI not showing as much cooling as some had hoped, there's a bit of renewed anxiety. Will the Fed keep rates higher for longer? Will the Fed possibly raise rates again if inflation remains above target? Remember, we've had a series of rate hikes to combat inflation, and Fed officials have signaled they're data dependent. That means that if the inflation needle isn't moving down fast enough, they might not hesitate to tighten policy further. So the PPI report is just one piece of a puzzle, but it's not enough. It's enough to essentially start to make investors a little bit jumpy. So moving over to the crypto market, traditionally crypto has been seen as a hedge against inflation, but in practice, it's behaved a lot more like a high-risk, high-growth tech stock, often trading in tandem with other tech stocks, and bond yields jumped on the PPI news. And Bitcoin and other major cryptos, they experienced an uptick in volatility. Bitcoin initially dipped on the release, suggesting that a higher for longer interest rate environment could dampen the appetite for speculative investments. However, crypto markets have shown resilience in recent months, often bouncing back when traditional assets start to falter. Part of that could be due to the continued institutional interest in the developments like Bitcoin ETFs, or anticipation of them essentially, and ongoing adoption curves for Ethereum and other blockchain-based systems. Yet short-term, the inflation data definitely influences sentiment. If inflation remains persistent, you might see less liquidity flowing into high-risk corners of the market like tech stocks and crypto. In regards to other risk assets, I think that smaller tech stocks, meme stocks, or emerging market equities, they often move in response to change in global monetary policy. So if yields continue to climb, we could see headwind for these types of assets. On the flip side of that, if the market interprets the PPI data as not too hot, that might lessen some of the fears of an aggressive Fed, given that the risk assets, it kind of gives them a little bit of breathing room. But right now, it's kind of a waiting game. We pretty much have to wait until tomorrow to find out about CPI report. And that's because tomorrow's CPI report, that's the main event for markets this week, because CPI, or consumer inflation, it's more recognizable and influential, essentially for the everyday spender. And Fed policy is dependent a lot on this report. So all eyes are going to be on how this consumer inflation number starts to compare to last month's, and whether they reinforce or contradict the message from the PPI report. Current forecasts are showing that the CPI year over year might come in at 2.6% in tomorrow's report, down 0.1% from the previous month, 2.7%. That would suggest that a slight deceleration in consumer level inflation, which generally would be good news for markets. So essentially, a reading near or below expectations usually takes a bit of pressure off the Fed, essentially so they don't have to keep tightening. However, if CPI surprises everybody and to the upside, it's going to rattle markets. They're not going to like that very much. So let's explore some scenarios for tomorrow. So first would be that CPI comes in or below the 2.6. Stocks and crypto might get a rally because traders see this as confirmation that inflation is steadily cooling. Bond yields could stabilize or even pull back a bit, reflecting reduced expectations for further rate hikes. The Fed might keep rates elevated for a little while longer, but a lower CPI reading could lessen the urgency to raise rates any further. Now, the second scenario is that CPI surprises above the 2.6 projection. We could see another jump in bond yields. Stocks, especially growth and tech, might sell off. Crypto could face a heightened period of volatility as investors start to weigh the long-term path of taming inflation. The Fed will likely hint at more rate hikes and tightening of fiscal policy if it starts to come in hot. The Fed's next meeting and the press conferences that follow will be crucial in interpreting these results. Fed policymakers have said that they're data dependent, which means that inflation readings carry a whole lot of weight for them. Now, you might be thinking, I'm not an economist, Leo. Why does any of this matter to me? Well, if you have a 401k or a Roth IRA or some kind of crypto in a wallet somewhere, you're affected because high inflation eats away at purchasing power, but also it can drive central banks to raise interest rates, which affects everything from mortgage rates to businesses borrowing money for their daily operations, and that cascades into corporate earnings, stock valuations, and just the overall mood of the entire investing world. For short-term traders, the next couple of days could be a roller coaster. You'll likely see rapid price swings in the market. Whenever I was actively day trading futures a lot, whenever we'd have a CPI report or some sort of a news report, I would never trade within an hour of these events, just because it increases volatility so much. For long-term investors, the big takeaway here is whether inflation continues to trend down in a meaningful way, letting us move towards a more stable economic environment, hopefully with less fear of potential Fed rate hikes. Now, there's an ongoing debate about whether we've passed peak inflation. Some economists argue that we hit the highest levels of inflation last year and that we're now on a downward trajectory, albeit a slow one. Others point out that certain core components like services inflation they're still running hot, and the global factors like supply chain disruptions or geopolitics tensions could reignite price pressures. I really don't see that being a thing. I think those are just people talking. The inflation peaked. It had much more to do with the dramatic increase in the monetary supply, the amount of money out there. That's ultimately what it was. You can't increase your money supply by 50% and not expect inflation. From the data we've got, it seems like we're in a phase of stubborn but steadily improving inflation. It's not vanishing overnight, but most indicators suggest that it is cooling. So tomorrow's CPI and the next few reports are going to be crucial for us sorting this all out. But I think that pretty much wraps up this report on PPI. Don't forget to like, subscribe, and share this video. It truly does help grow the channel. And until next time, y'all take care.